Hi Andy, how you doing, man? So, folks, we're just about to start. It's coming up to 6:30, 6:29, and I'll start exactly at 6:30 as promised. Well, good evening, everyone. It's exactly 6:30 in the UK. I'm David Paul. I'm sitting here in West London, Notting Hill. Lovely afternoon, so I hope it's as good where you are. Welcome to our VectorVest webcast, a proven approach to build wealth quickly and safely on the London stock market. It's a conservative approach, but those of you that class yourselves as aggressive traders, the conservative approach has done exceptionally well and outperformed the market. And I doubt if there's many people out there that are trying to do battle with the market on an intraday basis, trying to trade the indices or trade Forex, that would have done any better. And I'll show you the performance later on in the presentation. I tested the approach very carefully over a 20-year period up onto 2016. Since 2016, that's 5 years now, I've been in fact testing it going forward with my own money. And it's had an exceptional couple of years. There's not that much to do. And the VectorVest program automates most of the approach. So let's make a start. Hi Trine, how are you in Copenhagen? So the first thing I have to put up, ladies and gentlemen, is our disclaimer. VectorVest is authorized by the FCA. I think under correction, it's pretty much the only organization that sells investment software and investment education in the UK that is authorized by the regulator, the FCA, and I've got my quarterly audit with them, in fact, next Wednesday. I am qualified to dispense financial advice, but I can't do so because I haven't sat down with any of you and done a long and a detailed fact find. I'm allowed to talk about those shares that I hold myself, but I have to make it very clear that although those shares are suitable for me, they may not be suitable for you. And if you come on my Monday afternoon sessions, you'll know that I've got a couple of gold stocks in there, and gold stocks are certainly not suitable for everyone. So that said, we can move on, and my objective is to show you how to invest with confidence and outperform the market in less than 10 minutes a day. Now, let me get this clear because I've confused people in the past. We're not talking about day trading here. I'm not talking about buying the market at 9 o'clock and selling it at 10 past 9. Nothing could be further from the truth. What we want to try and do is to use the power of VectorVest to find really, really good investments that are rising in price and manage those in 10 minutes a day. And my motto for years now is that don't avoid risk, manage risk. I'm going to try and put that across in the next 45 minutes. Quite a tall order, I know. And the objective is to use the power of compounding to show you how to retire younger with more money than you ever thought you could by 3 things, if I can get my pen. The first thing is clearly maybe a bit obvious: capital growth. We want to buy shares that are going to rise in price. That's the first thing. Second thing, dividends. and we want to reinvest the dividends into the mix. Now, I have a PhD in mathematics, and when I sit down on Excel and do those compounding sums, adding in the dividends, the growth is such that I'm impressed every time I do it. The third thing, which is really difficult in the UK, is writing covered calls, which is a conservative option strategy on the shares that you've got for extra income. Now, this wasn't always difficult in the UK, because 20 years ago, it was quite easy to do. There was a very active traded options market at LIFE, the London International Financial Futures Exchange. They used to sit in where IG is at the moment in Cannon Bridge. Now, my colleagues in the States tell me that by writing options conservatively, you can probably make an extra 5 to 8% a year on the shares that you own. And that you can also add into the mix. Now, this is not a subject for tonight, but my own strategy is that I do something on the side, and I do some swing trading, short-term trading, and I add that into the mix as well. In fact, last week I bought Persimmons, the stock. It's a recovery play, not a true worry-free play, and I rated my spread betting account for the LUT for that. So that's my personal plan. I haven't got the ability to write covered calls, and in other webcasts that I do, I'll show people how to go about swing trading as well. But what we're going to try and talk about tonight, folks, is getting wealthy by finding shares that are going to rise in price without a great deal of fuss, that pay a dividend, and then I would urge you to have the discipline to keep your hands off the dividends, add them into the mix, because it makes such a huge difference over a few years. So at the moment, VectorVest are running a covered calls course, and I'm presently doing that course because I'm interested in the whole concept of getting a little bit more income into the mix by covered calls. That has to be done in the US market, which is a step for me. So that pretty much summarizes my own personal strategy in building wealth. Okay, I say this in every seminar. If I was managing your money, I would put 80% of it into 1 and 2. And if 3 were possible, I would write some covered calls in the shares that we've got. And with the extra 20%, I would have a go at some swing trading to actually add that back into the mix as well. So that would be my plan. Now, the plan is not that unique, because that's essentially the plan that George Soros used in the Quantum Fund over many years. He did swing trading for income, added that into the mix in longer term shares. So what I'm doing is not that novel, and it works. It really does work. Okay, so that said, we can move on, and that bald-headed old bugger is yours truly. Unfortunately, a day or two off 66. I can't believe it. I just can't believe it. Some mornings I wake up and I think I'm 36 and I get scared. But 66, reasonably fit. I've been in the gym twice today. I've got my first degrees in mechanical engineering. I have an MSc in metallurgy. I've got a PhD in applied mathematics. I've been trading in the stock markets of the world since April 1982. I gave up a very good job at De Beers, the diamond people, in 1988. I was head of engineering, research and development for them, and I gave that up to become a full-time trader in 1988. My poor mother nearly had a heart attack, but nevertheless, I've been a self-supporting trader ever since. And over the last 10 years, I've been helping people improve their performance with VectorVest. Now, I started off in South Africa because I went to South Africa in 1981 to play rugby. And that's where I first started to trade. And I went to South Africa for 6 months to play rugby for Transvaal, a provincial side. A great period. I went for 6 months and I stayed 35 years. So I started with VectorVest in South Africa. And then my son and I, we built up VectorVest South Africa. At one stage, it was 3 times the size of VectorVest UK in terms of subscribers. And 7 or 8 years ago now, VectorVest asked me to do the same here. And I came back to the UK permanently. I commuted for a while, but permanently 5 years ago. I'm very happily settled here in West London, although I am presently about to emigrate to Hampstead in North London. So that's me, but that's what we're going to talk about tonight. The VectorVest system of analyzing shares. Now, during the course of the evening, folks, you'll find me, I'll use shares and stocks interchangeably. Okay, so same thing to me. The second thing we're going to talk about is market timing. Now, that is controversial, I know. At VectorVest, we believe that there's a good time to be in the market and an awful time to be in the market. And that is a controversial statement because pretty much everywhere you go, everywhere you read, will tell you that you can't time the market. Well, I'm going to show you how to time the market. And then I'm going to fuse this all together into a simple, worry-free investing strategy that you can focus on executing. So we have to start with the VectorVest system of analyzing stocks. Now, 3 important words: earnings or profits, inflation in the general economy, interest rates in the general economy. And based on those 3 things, Dr. Bart DeLido, who's the founder of VectorVest, has put a value to every share in the market every single day. And as a default, we would like to trade in shares that are trading below their VectorVest valuation. And recently, folks, if you've been reading the financial press, you will know that the markets have got the heebie-jeebies about inflation. That interest rates may have to go up. And as you can see here, value of your stock goes up when it makes more money. That's quite obvious. When inflation in the general economy falls and when interest rates fall. Now, when inflation goes up and interest rates go up, unfortunately, valuations fall. And that's what's caused the noise and the pullback in the market that we've seen. The big question on every economist's mind is this inflation just something that's been caused by supply disruptions due to COVID, or is it going to be much more prolonged? Those of you that are unfortunately the wrong side of 50 and 60 will remember what happened in 1970. That's the last time we had a bout of inflation where prices went through the roof for a 3 or 4 year period. Anybody old enough to remember that? That's, and if you've read the press, you've heard people rattle on about inflation. There are as many solutions to this as there are economists. So at VectorVest, we believe that every investor should know, what's the stock really worth? How safe is the company? Some idea about the trend. Is the darn thing rising? Is it going sideways and you're slugging it out? Or is it falling? Buy, hold, sell. Now, this evening's presentation is all about worry-free investing. And if you'll excuse the rugby metaphors, we want the ball to do the work. And I'm going to focus on safety and predictability of earnings. So I'm going to focus on a hands-off plan and find exceptionally safe shares, shares that are in fact have a track record of making money and all their financial ratios are getting better. So let's see how we do that. The first measure of value that we use in worry-free investing is called relative value. Now, relative value is a prediction of the long-term share price appreciation potential in relation to what a corporate bond will pay in the same period. This is a completely unique number in the investment industry. And I'll explain why in a second. So how do we do this? Well, the VectorVest program estimates the profits, the earnings that every company on the London Stock Exchange is going to make over the next 3 years. So 1 year out, 2 years out, 3 years out. We do that by extrapolating from the financial statements, and the data that we use is exactly the same data as the city analysts will be pouring over tomorrow morning. And by purchasing a earnings growth forecast from the world's leading provider of such, a company called FactSet. So we get a good feel for what the company will make next year, the year after that, and the year after that. You've got exactly the same data as the top city analysts will have. We make the following assumption. We assume that those earnings are going to be discounted into the share price at some time over the next 3 years. And we calculate what that price will be. We take the projected price and subtract the price today to get the upside, and we divide that upside by what a corporate bond will pay in the same period. Now, everything on VectorVest goes from 0 to 2. Now, less than 1 is not good, folks, because this would mean over that 3-year window that we believe that the share price appreciation potential is less than what a corporate bond will pay. And those of you that, in fact, understand the pecking order of payments in a company will know that the bondholders get paid a very long way ahead of the common shareholders. So you would be taking risk in something as intrinsically risky as a common stock for much less than you would get from just being a bondholder. Now, greater than 1 is not bad. It's outperforming a corporate bond rate. And we've proven, I've proven, and our customers have proven that if the relative value is greater than 1.25, that seriously increases our ability to find a portfolio of shares with strong capital growth. And the first parameter that we're going to consider for a worry-free investment, a hands-off investment, is that it has a relative value of greater than 1.25. Just remember, our first method of building wealth in the stock market is that we want to buy into stocks that are growing earnings strongly, and sooner or later, within that 3-year window, that's going to in fact be discounted into the share price. Now, relative value is a prediction of the future. And it answers an age-old investment quandary. And that is it better to buy a share on a price to earnings ratio of 80 or 5? Now, the conventional method of valuing a stock is called the price to earnings ratio, the PE ratio. And what that does is that it tells you how many years earnings is it going to take to pay off the stock. So a share on a PE of 5, you're going to pay for that stock with 5 years worth of earnings. A share on a PE of 80, it's going to take 80 years to pay for that stock. Now, simple-mindedly, it would seem obvious that a share on a PE of 5 is in fact better than a share on a PE of 80. But as one of my mentors in the stock trading business says, long since dead, William Delbert Gann, he says that if it's that obvious, it's obviously wrong. Now, relative value answers that question. A share on a PE of 5 could be a wonderful buy, but it could also be what's called a value trap. If the earnings are falling through the floor, at 5, it could be vastly overpriced. Just remember, PE is looking back. A share on a PE of 80 could be a snip if the earnings are rising through the roof. And just remember, companies like Amazon have been on a PE of 80 and much, much higher for a decade, and they still keep going. That's because the earnings are rising strongly. So what relative value does is that it tells you, is it better to buy a share on a PE of 5 than on a PE of 80? If the relative value is above 1, it's good. So a share on a PE of 5 with a relative value of 0.75 is a dead duck. A share on a PE of 80 with a relative value of 1.3 could be an exceptionally good investment. So relative value is an incredibly useful number, and I believe the most important number on VectorVest, because it answers that question that's been rattling on in traders' minds and investors' minds since investing started. And I use the example of a PE of 5 because a friend of mine who ran the investment team for a major London-listed bank and Johannesburg-listed bank, he left and he started up his own shop. And he, in fact, lost his business because, like we all do for every now and then, he fell in love with a share on a PE of 5, kept buying more and more and more of it because he thought it was a snip. And that company, of course, the earnings were going through the floor, and the company was on a PE of 5 for a very good reason. It was going broke. I've managed an awful lot of money in my time, and if you run a little fund, and one of the shares in your fund goes bankrupt on you, you'll find that your investors run for the door. And he lost his company based on that. So relative value, an incredibly important number. I could talk about it all night. The second important number and vital for tonight's discussion is relative safety. And this measures risk. As the slide says, it measures the consistency and the predictability of financial performance. So we buy the data, the financial data from Thomson Reuters. The data that you get in VectorVest is exactly the same data as the investment analysts in the city will be pouring over tomorrow morning, except you get yours at 8:15 at night. It looks, Dr. Toledo's algorithm looks at the balance sheet, the income statement, the cash flow statement. It looks at sales, it looks at margins, it looks at dividend safety, dividend yield. Sucks them all up and spits out one number again on a scale between 0 and 2. Less than 1 is not good. This is a company that may not be making money, and all of the financial numbers are jumping up and down. Far from a worry-free investment. Could be a wonderful swing trade over 3 or 4 days, 3 or 4 weeks, where you're managing risk by watching it like a hawk. But that's not what we're after here. We want the ball to do the work. Greater than 1 is not bad, and greater than 1.2 to 1.4, this is a stock that's making money, and all those financial ratios are getting better. And I like to see shares, worry-free stocks with a relative safety getting up around the 140 level. That's the second parameter in our worry-free search. And in fact, what I'm going to do is that I'm going to sort all of the shares on the London stock market by relative safety to bring the safest ones to the top of the pile. Now, here's what we're looking for in a worry-free technique. We're looking for some very special stocks. We're looking for stocks that have got the ability to grow their earnings strongly, RV greater than 1.25, and safely, RS around the 1.3 and above level. And there's not that many of those on the London stock market itself. Very special instruments. There are more of them on the American market because there's 4 or 5 times as many stocks on the American market. Very special stocks indeed. And we're going to find those stocks in a moment automatically using the program, using UniSearch in the program. The third VectorVest metric is a measure of the short-term price trend, RT. And if we were talking about a momentum-based evening, then this is vitally important. The short-term price trend, not that important for what we're going to talk about tonight. Again, less than 1, the darn thing is falling. Greater than 1, it's rising. And the further above 1, the faster it's rising. And then what Dr. Toledo did is that he put all 3 things together into the master indicator VST, value, safety, and trend. And this is in fact why I first came to use VectorVest, because it was this guy who put together fundamental analysis, RV and RS, with technical analysis, RT, into the one single number. I'd never seen that done before. Now, if we were talking about momentum trading, then the VST sort makes a really, really good job. But we're not talking about that tonight. So tonight, I'm in fact going to sort all of the shares by relative safety to bring the safest ones to the top of the pile for our hands-off, worry-free investment technique. We put a stop loss to every share in the market every single day. And we calculate that automatically for you. And it's based around a 65 13-week moving average, but it's adjusted for the fundamentals. And if the fundamentals are good, and they will be with worry-free stocks, high RV, high RS, we give the stock more room to move. The objective of the VectorVest stop loss is to weave a very fine line between keeping you in a winning investment and protecting your capital. And that's a very, very fine line to weave. Those of you that have been in markets for a while will know that before a market runs, it invariably blips back. We had this last year on JD Sports, in fact. The market was in a bit of a range, and a lot of people, including one of our subscribers, had their stops under these lows. The VectorVest stop was down here somewhere. But what happened before JD, in fact, made about a 40% move up, It went down and did that. And it was down in there for an hour. So the VectorVest stop loss is placed out of the traffic for shares with very strong fundamentals. And that gentleman who got stopped out is from our Oxford group, and we had a grown man in tears because he just got stopped out of a 40% move after holding it for quite a while. So invariably, markets will run stops before a big move, and that's nothing more than institutional traders getting their best clients in at a good price. And I know exactly how they do it because I did it for years myself for clients. You get your clients filled at the high of the week, and you won't have clients for very long. So if you want to eat, you get them in at a good price. So the VectorVest stop loss does its best to weave that fine line. It is a very fine line between keeping you in this move and protecting your capital. And we put a buy, sell, or hold to every share in the market every single day. Now, for our worry-free technique, folks, we want shares that are either on a VectorVest buy or a VectorVest hold. If they're below their stop loss price, we certainly don't want them in our technique. So we're happy to get into a share on a buy, share on a hold. Where it's because they slug it out frequently. They'll go like, markets don't move in straight lines. They run and then they go sideways and then they run again. And sometimes you've got to sit through this hold if you want to get the big move. Sorry about that. This pen's more difficult than it would seem. So I just want to go out of this now, end the show, get rid of, discard all my funny lines, go to the program itself. I'm going to explain the front page of VectorVest in a second. It's all about, the front page is largely all about the overall market. If I click on viewers, it'll take me to the stock viewer where we follow 2,063 shares that are on AIM and on the London stock market. Okay, that's I'm streaming this on YouTube, folks, and that's the contraption that makes it work over YouTube. Disconnected there for a second, so I hope it's okay. The default sort is VST. Remember, value, safety, and trend. And it's a spreadsheet, so you can click on any one of them. And I suppose I better make sure this is working. It does seem to be working. Excuse me for that. Cape Tech is right at the top as sorted by VST. And that's the code. It's on AIM. Oh, thank you, Trine. That's very kind. It's trading at 332. VectorVest believes it's worth 443. So immediately we can see that this is significantly undervalued by the market. It was up 2.5 pence yesterday. The value is a proprietary VectorVest calculation, Dr. Delito's calculation. Clearly the price you can get from the paper for nothing. I'm dating myself by even thinking about a newspaper, I suppose. You get it from the internet for nothing. The second proprietary number is RV. And RV, remember, measures the price appreciation potential against relative to a corporate bond on a scale between 0 and 2. And 1.58 says that it's going to outperform a corporate bond by 58% over the next 3 years. Now, above 1.3 is excellent, and I have my own number for 1.58. That's called, in my book, bloody marvelous. That's a really cracking number. Relative safety at 1.19 is just pushing into the worry-free area. It's a bit on the low side. RT at 1.85 tells us the short-term trend is in fact going up the page pretty much vertically. VST 1.58, RV, RS, RT all rolled into one, and VST is the highest in the pack. It's on a buy recommendation. That's the stop loss. Now, I didn't get time to talk about CI. CI measures the long-term trend on a scale between 0 and 2. It's also great. GRT is the percentage annualized growth rate next year, which is 33%. That's a big part of RV. So there's a bit of belt and braces between the growth rate and RV. And this share is on a PE going forward, guys, of 23. Going forward, if you go to the Financial Times, you're going to get a different number because they're looking back. We're looking forward. That's what VectorVest does. It looks forward. So this share could easily be a worry-free share. RS is a little on the low side. If we have a look at the chart, there's the chart, and as you can see, I've got earnings per share on the bottom here, and as you can see, it broke out here. It was in this lovely rounding bottom for those of you that are technicians, and then gapped on news, and it hasn't looked back since 250, still going. The VectorVest valuation, I'll put that on, is right up here at 450. And as you can see, as the earnings came in, we revalued the share. I use 3 moving averages, but if you like moving averages, great. If you don't like them, then the VectorVest buy signal does a good job. If I get rid of the value, I use 3 averages, 21, 55, and 89. And ladies and gentlemen, where they all come together there, that's a very special point on the chart. And that's what an old fella on the New York Stock Exchange, he told me, that's called a bow tie. That's a very, very special spot on the chart. And as you can see, VectorVest had this as a buy from right here. And it went to hold for a day or two, didn't hit its stop loss. So it's been on a buy since less than £2. That was in last November, and that's been a great run. As a technician, I would struggle to buy into it. I wouldn't have had a problem here buying in 3 as it broke out. I would struggle to buy into it now. I would wait for it to pull back maybe a little bit. But I frequently miss them because of trying to finesse an entry, the best ones just keep on going, folks. So that's Cape. I've got a question here. Brian says, does the RT say that RT can stay up there trying for a very long time? When markets trend, they can stay in an overbought position for a very long time. So it just tells us that the share is trending strongly. And you certainly wouldn't want to short a stock just because it's got a high RT. That's a reversion to the mean trade, and that's a quick way to go broke, all right, in my humble opinion. Future is about fully valued. But if we go across to RV, it's saying that over the next 3 years, there's still one hell of a lot in the tank. It's going to outperform, for the moment, pretty much fully valued, and maybe a tad above value, but it's got an RV of 1.55, RS of 1.26, which is acceptable. It's got a VST second highest in the pack. The CI is marvelous. Growth rate at 36% next year, and on a PE of 28. We've got dividends and whatever right to the right-hand side. And if I right-click here and pull up future, that's what it's done. And it's pulling back quite nicely indeed. There is earnings per share. This earnings per share on VectorVest is quite a magic tool. And we had a wonderful presentation from a young man on what's called earnings per share kings last Wednesday night at our national user group. And the power of this VectorVest forecast earnings per share to predict strong moves. This is what Ben Graham, Warren Buffett's mentor so many years ago, said, that earnings per share growth is the engine that drives the share price. It's a leading indicator of change. This earnings per share has gone from 60 pence to 95 pence in the last year, and that's driving this share price. And as you can see, it went on to a buy here. It was on a sell there for a while, aggravating. It went on to a buy just here, and it's kept on going. Pulling back a little bit, I would suspect it's going to pull back to that 25 level. But lots and lots in the tank in future. Okay, so that's an example of two stocks. I'm holding Games Workshop. I bought into it at £50 last April, and it's now at 114. As you can see, the RV and the RS really up where I want them to be. Okay, really up to where I want them to be. So I'm holding a lot of these stocks, and I'm very happy with them as well. So Sylvania Platinum is a stock that I'm holding. It's got outstanding growth numbers. I came back today a little bit on platinum worries and resource worries, but it's got RV of 1.85, RS of 1.32. We're still watching our stop losses, and I advised that on my Tuesday update today. So, yes, it went down today, that's for sure. It went down. All commodity stocks went down today. So we have to be very careful. Just because they've got a high RV and a high RS doesn't mean that they can't drop the ball. It means that they're much, much less likely to drop the ball. Okay, so we still have to watch them. Last year we had one really good stock that dropped the ball. That was Avon Rubber. And it dropped the ball. It had a high RS and it dropped the ball on us. I see it's down another 10% today, back down to £30. So we still have to manage risk. We don't avoid risk, we manage it. But high RV, high RS stocks do not drop the ball that often. So the next part is controversial. And it's all about market direction. And our motto at VectorVest is buying rising stocks and rising markets. And if we were in another presentation, a more aggressive presentation, then we could talk about selling falling stocks or shorting falling stocks and falling markets. Now, in the UK, it's virtually impossible at the retail level to short stocks. You're going to have to open up a spread betting account or a CFD account to do that. Unless you've got £10 million in your portfolio, then a broker might, in fact, go around and borrow the stock for you to short. The problem with moving to a CFD account is discipline, because you get 5-to-1 leverage there, and that's really cool when it's going your way and really, really bad when it's not. So we're going to, in our worry-free technique, we're going to try and buy a share at £10 and let it ride, and maybe we get stopped out at £18 as it pulls back again and make the £8, congratulate ourselves, move to the next one. Now, Dr. Lado says, being the wrong side of the market is the worst thing that can happen to an investor. It doesn't have to happen to you. I was introduced to this by my father, and he told me that in 1969, the London stock market made a high. It then took 21 years, ladies and gentlemen, for the London stock market to break that high in real money. What happened? From 1969, the market went into a bear market that lasted to 1981. From 81 to 90, there was a great market, apart from 87, which didn't last long. But it took from 81 to 90 to break the 69 high in real money. 21 years. Now, I don't know about you guys, but I haven't got 21 years to wait. If we look at what's happened now, on the 1st of January 2000, the FTSE 100, after a great few years, the FTSE 100 made a high. Now, 21 years later, it's still sitting about the same level. During that period, it went down to 2003. It ran to 2007, fell through the floor to March the 9th, 2009. And apart from the odd splutter like COVID and the Euro crisis, it's in a bull market ever since. So within the 21-year periods, there have been some great moves, but the overall market has gone nowhere. Now, clearly, if you'd banked the dividends, you could have done okay. If you'd sort of bought a little bit every month, you would have done okay, because you would have bought at the lows and made something. But nevertheless, a very simple timing methodology would have put you on the right side of that. And we're told by everybody to ignore market direction. And if you've got £100 million fund, maybe you've got no choice. But when I get to 100 million, I will worry about that then. At the moment, I can get in and out relatively easily. That's my metaphor for a stock market. It takes forever to get up and then falls very quickly, as we saw last February and March. And the next fall will be no different. So the front page of VectorVest is set up so that we can see what the general market is doing at a glance. Now, this is my belief, therefore it's true for me. I believe that 70% of the exercise, 70% of your ability to make money will be staying in sync with what the general market is doing. And it's all for you on the front page of VectorVest. Now I'm going to go out of my PowerPoint and go into the program itself because it makes it a little bit bigger. There we go. There's VectorVest UK. VectorVest, folks, with our VectorVest subscription, we have UK, USA, Canada, the whole of Europe, and Australia. So you're not confined just to the UK. This is the front page of VectorVest, and it's laid out so that you can see what's happening in the market at a glance with no chart watching. Now, I'm going to show you the chart in a second, and I love charts. Spend hours looking at the darn things all day, every day, but many people don't. And if you're in a hurry and you're running, VectorVest comes on an app in your phone, and there's a really cool little app for both the Android phone and what's the other one? The Apple phone. And you can see whether the market is rising or falling in a glance. I'll explain the little colorful color guard in a second, but the two most important words on VectorVest are these two: up and up. And I hope you can see those. The first word refers to the short-term trend of the London stock market. The second word refers to the underlying trend or the longer-term trend of the London stock market. Now, that confuses some people. If you think of those two measures of the trend as a little boat and a big boat, so a little small dinghy launch and the aircraft carrier, the Queen Elizabeth, for example, I think you would agree that the small little launch can go back and forward and turn much more quickly than the Queen Elizabeth. Similarly, the short-term trend can reflect short-term moves in the London market, whereas the underlying trend smooths those out and doesn't see them. So the short-term trend is up, the underlying trend is up, And we have a confirmed up in place. Now, the confirmed up is the signal that we use for worry-free investing. And the confirmed up is no more than the underlying trend confirmed by 2 weeks price action. 2 5-day price actions in a row. Now, the confirmed up signal smooths out a great deal of noise and keeps us in sync with the long-term investing trend in the market. That confirmed up, ladies and gentlemen, has been in place since the 11th of November last year. I'll show you it in a second. Now, for our worry-free investment technique, we want both boats to be heading in the same direction. That the small boat and the big boat are heading in the same direction. And we want a confirmed up. And that's where this traffic light comes into play. The traffic light measures the short-term trend, but it measures the strength and the momentum and the breadth of the short-term trend. And by breadth, I mean the number of shares on a buy of the overall market divided by the number of shares on a sell. And that tally is kept in this table, which you don't need to worry about at the moment. We'll talk about it in detail at our Monday afternoon sessions. But the traffic light is saying today that the momentum and the strength and the breadth of the short-term trend is somewhat bullish. VectorVest advocates buying safe undervalued stocks that are rising in price at this time. So we've got a confirmed call in place, and the short-term trend is up, and it's up with conviction. And that's the signal that we decided upon a couple of years ago to use for our worry-free investing, and that was in fact decided and put forward by one of our subscribers down in Wales, Carwyn, if you're listening. So that's what we need. And in fact, I added to a worry-free stock this morning based on that. So a confirmed up and the pointer in the green and the advice looking good. Now, where does this all come from? Well, first of all, ladies and gentlemen, you do not need to look at charts. All you need to do is to look at this, glance at this once a day. There's a confirmed up in place, all is good. On a day that you want to buy some stocks, if you've got some money, confirmed up and the pointers in the green, that's a day to buy stocks. This VectorVest market timing system is based on the VectorVest composite. That is the VectorVest composite. It's an equally weighted index of all of the shares that we follow on the London market. Now, there's a great deal of indicators, but I've just given a raw chart here. And if I go back, let's say, to the COVID disaster, just about there. On this chart, all VectorVest charts, we have this drop down. And in the drop down, we've got all the VectorVest market timing systems. Short-term systems for spread bettors that want to be in the market for 2 or 3 days. And longer-term systems for investors. Now, the confirmed call is the system that we're going to use for worry-free investing. Primary wave is a very short-term, very noisy system. The DEW is a market timing system that I find very useful for swing trading. Medium-term market timing systems. And the green light bar, these ones are somewhere in between. If I click on confirm calls, it populates this chart with red and green triangles. And that, ladies and gentlemen, is the confirmed up that we got on the 11th of November. And on the front page of VectorVest, that confirmed up has been on that table every day since the 11th of November. Now, along the way, the short-term trend has been down. In fact, in this period, the short-term trend was down, I think, for 10 days in a row, and it's just turned up over the last 4 days. So we want to buy in when there's a confirmed up and the short-term trend is saying yes, to give our position a little shot in the arm. So there was a confirmed down, didn't last very long. There was a confirmed down where the world sort of ended. If I go back a little bit further, there was a confirmed up in October that year, in 19, yeah, there we go, November, 24th of October, ran to here. And as you can see, the confirmed call system has ignored all this noise and stayed in sync with this trend. I'm very, very positive about the UK market. I think that there's going to be noise and it won't give us money without a little bit of angst. But I think that we're going to see a very strong few years on the London market to make up for that flat period, flat lining period over the last 21 years. So I think we're in the right place. Our market is cheap, and as long as the American market doesn't fall apart, I think we've got a wonderful 2 or 3 years ahead of us. Now, here is the process. When we get a confirmed up, we want to be fully invested with shares that have got a high RV, high RS. And I say it again, if I was managing your money, I would put 80% of your money into those type of shares. With 20%, I would do some swing trading, trying to catch these small moves here. Add to the mix. A lot easier said than done, I may add. If you don't believe me, have a go. So I was fully invested. Now that was last April. And last April things were far from rosy, if you remember. That was the start of the COVID lockdown. In Notting Hill here, there wasn't a soul. Now normally in Notting Hill, I avoid the tube station at weekends because of the market. And either walk to Holland Park or Queensway because the tube station is so chock-a-block. There wasn't a soul in it last April. The red buses were driving around, just the driver in them. I bought stocks down here. Everybody who comes to the Monday afternoon session that I do will know that. And I was laughed at. And I got emails from people, quite colorful emails. When it's time to buy, you won't want to. Okay, always. Now, sooner or later, there's going to be a red triangle. All right, sooner or later. And this, just remember, this was the second lockdown, and that was when the Kent virus was going to come and get us all. And that didn't last very long. Now, when you get a confirmed up, we want to be fully invested. In a confirmed up, there is a very low probability that will be stopped out of any share that's got a high RV and a high RS. It certainly can happen, but the probability of it happening is low. When we get a confirmed down, there's a much higher probability that you're going to get stopped out of even a high RV, a high RS stock. So when you get a confirmed down, you really need to be very careful in watching your stop losses carefully. Now that can all be done on the app. Your shares can be put into a watch list and you can watch those on the app when you're on the go. There's no excuse. Let's face it, we spend 80% of our days staring into the bloody phone. I don't mean to be dogmatic, but there is no excuse. In this pullback, I wasn't stopped out of anything. Confirmed up. So the shares that I had kept running here. I was stopped out of one share, Avon Rubber, somewhere about here. It had a high RV, a high RS, but it dropped the ball. I simply found another share to go into. So in this little pullback, I wasn't stopped out of anything. I was watching stop losses carefully, but I wasn't stopped out of anything. In this one, I was stopped out of everything. Everything. Just there. Now, that's the first time that that's happened since 2007, where we've been stopped out of everything on a pullback. So here's the process, ladies and gentlemen. When you get a confirmed up, we want to be fully invested in high RV, high RS stocks, shares that have got a history of making money safely, got a history of growing their earnings strongly and safely. Sooner or later, we're going to get a confirmed down. When you do get a confirmed down, there's a much higher probability that you're going to get stopped out. So you need to be more on alert when there is a confirmed down. If you do get stopped out of a share, you do not repurchase. You build a cash position. So let's assume that we were stopped out of 3 shares in this pullback. They closed below the VectorVest stop loss. We stopped out of 3 shares, we would be 70% in stocks, 30% in cash. When you get the next confirmed up, you run my little uni search, which I'm going to show you in 2 minutes now, and replace so that you're always fully invested. Ladies and gentlemen, if you want to get wealthy, you need to be fully invested when the general market is rising. In this pullback, I was stopped out of everything, so I went into this new period. I was fully in cash in this period here. And that's the process. It's a very simple process. Before you start on this, we'll go through it with you in a great deal of detail, but there's nothing much more to it than that. So let's see how we can find these shares. How to build and manage a worry-free portfolio. Those of you that read my essays at the weekend, those of you that have listened to me talk, I'm very emotional about execution. So we do our best to get you to a point where you can execute this easily without a great deal of effort. And VectorVest does most of the work. UniSearch is a tool that will allow you to actually allow us to input all the measures of RV, RS, technical measures that we require to find shares that suit our objectives. The search that I've got for worry-free investing is very simple. We could write very complicated searches, or certainly more complicated searches, such that Colin used last Wednesday night. And from our Oxford group, we've got another fellow called Mark, who is an absolute whiz kid on our UniSearch, builds the most magnificent UniSearches. So you can have a great deal of fun finding stocks that suit your objectives, both fundamental objectives and technical objectives. There are dozens of searches that are preloaded, but it's always best to write your own. And we want to try and find the very best stocks. Those stocks that have got the best combination of growth and safety. If we were momentum traders and we're managing stop losses very carefully, then we could get away with growth alone. But for this portfolio, we're looking for this mixture of growth and safety. The portfolio needs to be robust and tested. Now, I tested this for 20 years, from 1996 to 2016. And since 2016, I've been doing my best to test it going forward with real money. The objective is to have very, very few trades. Because every time you will notice that every time you press that button, it costs money, and you've got to pay 0.5% stamp duty. So the key is relative safety. We want that relative safety to be certainly above 1.25, and to ensure that we reach our capital gain objectives. I want growth rate to be well above inflation and interest rates, and that translates, folks, into an RV of greater than 1.25. And that's the little search that I've designed to actually make this happen. Looking for shares that are above 50 pence. I put on a very low traded volume here. The 50-day moving average of volume is only 50,000 shares. I think that if you were trading with a large portfolio, you're probably going to have to up that a little bit so that you've got sufficient liquidity to get out when your stop loss does hit. It's always easy enough to get in, but getting out can be problematic if everybody else is trying to get out. So you want reasonable liquidity. In this particular search, that little double R means not, and I've excluded AIM, but some of our subscribers feel that that's not necessary, and if RV and RS are high, that AIM is fine. So, but on this I've been ultra conservative, and I've excluded AIM. The relative safety should be greater than 1.25, and the stocks should be not on a sell, thus on a buy or a hold. And the shares that come out of that, ladies and gentlemen, I've sorted by relative safety. I'm bringing the safest shares to the top of the pack. We're going to use our confirm call signals to get in and out. And remember, to buy stocks, we want a confirmed up, and the pointer of the color guard or the traffic light should be pointing into that green part, which tells us that the short-term trend or the little boat is in fact moving forward with conviction in the same direction as the big boat. And as you saw, the confirmed signals do an outstanding job in keeping us in the long-term trend and ignoring the noise. That's the VectorVest composite again. Those are the signals. And that is what it's done since last April. Now, this is to the end of April. So I'm going to go out of this now. I'm going to go to the program itself and have a look at this. So if I go to the program, that's America. If I go to the program Unisearch, that's the search. Maybe they're in a different order. And long-term winners, WFI. The stock's relative value is greater than 1.25. The 50-day moving average of volume is greater than 50,000. The stock's recommendations not on a sell. The stock exchange is not AIM, and the stock price must be greater than 50p. Sorted by relative safety. Now, if I go back to last November, that's the confirmed up, and it's marked on this little calendar for us. Go back to there, run the search, and that's what it came up with. And I am sure 80% of my portfolio is worry-free shares. And I have a couple of gold stocks for swing trades. I've got a couple of recovery building stocks for shorter term trades in there as well. But 80% of the cash that I have is in worry-free stocks. If I do a quick test of the top 10, it'll tell us the percentage increase. Now, a quick test is a bit agricultural because anything could have happened between November and now. We could have been stopped out. But we have a back tester that will do that in detail for you. But I won't get there tonight. If I do a quick test, we can see that that portfolio, folks, is up nearly double what the market has done. And as you can see, there's no losers. Okay. when the general market is rising, high RS, high RV stocks perform. Every now and then you'll get a high RS stock will drop the ball, but not often. Doesn't have to be you don't have to be looking at it in that amount of detail. It's a hands-off method. Now, over the last, this is a 32% annualized gain. And that's why I said at the start, those of you that want to be aggressive traders, I don't know that many day traders, and I know an awful lot of day traders that are making that type of money. And if you look at IG's website, they say that 75% of all the people who try lose money. So when you're competing in there in that short-term noise against noise itself, randomness itself, and of course the algos, it's a tough place to be. I love it, and I do swing trading seminars based on it, but it's not easy, and you need a level of discipline that's quite uncommon. So just be very, very careful about starting as a short-term trader with big amounts of money. Start small. There are brokers out there that will let you trade from 50p a point and build your technique and build confidence in yourself before you put a great deal of money into it. This is relatively easy. We're staying well away from the noise, and I don't care how many algos there are out there. If we've got a share that's growing earnings strongly, sooner or later those earnings will be in fact discounted into the share price. Nothing has changed since Ben Graham's day. Ben Graham was Warren Buffett's mentor and has written some wonderful books on investing. If we go back now to the first signal last year, which was way back in April, very difficult signal to take. The good trade is always the hard trade, and one of my first mentors always used to say, he was a desk head down in Johannesburg, he always used to say that when it's time to buy, you won't want to. If you get nothing out of this webcast, folks, write down the following. When it's time to buy, you won't want to. When it's time to sell, you also won't want to. Okay, that's the confirmed up last April. If I run that, you can see Avon Rubber came to the top of the pile. It's still today above where it was, but it pulled back and we got stopped out. I got stopped out along the way. By quick test, that portfolio, even with Avon Rubber in it, that portfolio is up 50%, which is 47% annualized off that low. I'm holding most of those stocks. So that's my story, folks. 2019 was a great year for the technique. It was up 48% in the year. And unfortunately, I gave back 15.5% of that. Pearson let us down. You should never take a 37% hit. It hit its stop loss well before that. But I lost 15.5% of that in the COVID sell-off, and went into April fully in cash. That is the equity curve in 2019. 2019, we had 2 trades the whole year in there. Stopped out of 2 shares on a confirmed down the whole year. And then, of course, in February 2020, I got stopped out of everything. Right? So not 2 trades the whole year and then got stopped out of everything in that period. That's my test. And as I say, I haven't tested it. I've tested it going forward and since. And I bought JD Sports today. So added to JD Sports. That's the equity curve over that 16-year period. That's 2000, 2003. That's the global financial crisis, and it's gone up a mile since that. So that, folks, is a 17% compounded rate of return. And it's American shares don't pay the same dividends as we pay. There's a 3% dividend yield, which I haven't added in. And by the way, the performance from the Unisearch that I showed you a moment ago is dividend free. If you add the dividends in, it makes one heck of a difference. Just try that little compounding sum on Excel. All right. By adding in the dividends, the growth goes through the roof. And if you can add in covered calls, it goes through the roof even faster. Oh, that's not easy. In fact, it's impossible in the UK environment. Our data has just been updated. So that's the data coming in exactly at 7:45. So you may be wondering how you can put this together for yourself. Well, you've got a choice. You can do it yourself. Now, I tried to do it myself, but I couldn't. And I spent most of my career swing trading technically. When I tripped over VectorVest 12 years ago now, I got involved as a customer because I now found this piece of software that would in fact do the fundamentals for me. Way back when I started in 1982, I can still remember the annual reports piling up in the corner of the office. That's why I chose this slide. In 1982, I was playing professional rugby, and we were playing to 60,000 people every Saturday afternoon. It was a magnificent period. My biggest crowd was 85,000. That was the opening of Ellis Park in Johannesburg, Transvaal against a World 15. So that was in 1983. So I didn't have the inclination to fight with the annual reports as well. So I traded technically, and then when I tripped over VectorVest, I had now this tool that would in fact do the fundamentals for me and serve them up in a format that's easy to understand. Information is completely useless if you in fact can't react to it. And most fundamental analysis reports are written by analysts for analysts, and they would confuse and do confuse. So to break out, I've got a plan, but you're going to have to roll your sleeves up for a week or two to take advantage of it. VectorVest is not a get-rich-quick scheme. I think it's a get-rich-slow scheme of anything. And I put together a method of making this all happen. For those of you that have got VectorVest, it's already on the VectorVest program, and I'll just map it out. So the first section is the detail of how to analyze any stock in 30 seconds, which is the detail of value, RV, RS, RT, CI, growth rate, dividends, all that sort of stuff. So that you can analyze any stock in 30 seconds, you can separate the good from the bad. And module number 2 is all about getting rid of the bad ones. How to size your positions correctly, to minimize losses, maximize gains. So module number 1, you sort the good from the bad. Module number 2, you get rid of the bad ones. Module number 3, when's it safe to buy in? You've got rid of the bad ones, you've got some cash. When is it safe to buy in? Which is the detail of the various market timing systems. And then module number 4 is what to buy. A cherry picking checklist for worry-free stocks and for momentum stocks. And then the last little bit is a plan to make it all happen. I've had it professionally narrated. You're going to have to listen to me mumbling on. Now, in the US, they charge a heap for that, but we're new in the UK, or relatively new. And if you roll your sleeves up and work with us over the next 30 days to make that happen, that's what we're going to cover. And it's a fiver, folks, or £5.95. VectorVest.co.uk/proven. And with that, we're going to give you 30 days access to VectorVest, which is worth £49 alone. And that's UK, US, Canada, EU, trying, unfortunately not. Scandinavia, and where else? Aussie. That's the VectorVest world at the moment. So all of those come with a VectorVest subscription. That's worth £49 on its own. If you want to stay with VectorVest, it's invoiced at £49 a month. It's on a month-by-month basis. And my promise to you is that if I can't make you money, if we can't make you money, then you can stop at any time. I've been with VectorVest now for 11 years. In those 11 years, there's never been one problem with a credit card. Okay, if we make a mistake, it's sorted out straight away. And got a question here. You can start anytime, Charles. You can start anytime. I'll show you where it is in a moment. You've got VectorVest, Charles, haven't you? It's built into the program. And as well as that, we have an 0800 number that you can call for support. It's open from 12 o'clock UK to 12 o'clock at night UK. I do a weekly session on a Monday afternoon where I summarize the market in detail, focusing on the UK and focusing on the USA. We have a national user group which meets once a month, where we have guest speakers from around the country. And we have an international user group that also meets once a month. My colleague in the States, Glenn Tompkins, does a excellent session on a Thursday. And we have groups that meet around the country. So vectorvest.co.uk/proven. And this young man is a farmer. He's from North Somerset, magnificent part of the country. He's been in the market now 30 years. He's never made a cent. He's always been buying on the high and panicking and selling on the low. And he now tells me he's got a written plan after all these years. So he's doing well. Folks, if you don't think it's the best £5.95 you've ever spent, you can have it back with the greatest of pleasure. vectorvest.co.uk/proven. And I'll just go to the program now. If I discard all my little notes, if I go to the program, and Charles, if you click on training, there it is. You can play it anytime. Okay. And very interestingly, folks, on this navigation training series, we have a series that opens in a different window. And we've got a series of 16 videos that explain every last little bit of the VectorVest program. So if you're struggling to write a uni search, these don't last very long. If you play those, that'll sort you out straight away. Otherwise, phone the helpline and there'll be somebody there to sort you out straight away. And this all comes with the 30-day trial of VectorVest. Okay. So folks, that's all I have to say. I've kept you longer than I thought I would. The worry-free technique finds the UK's safest shares that have got the ability to make lots and lots of money, to grow their earnings safely. There's not that many of them. And we want to buy those shares when the general market is rising, as defined by our confirmed call signals. When we have a confirmed up, we want to be fully invested. During a confirmed up, the probability of getting stopped out of a high RS, high RV stock is low, but it could happen. If it does happen, just simply get out, then run my little uni search again and replace, so that you're always fully invested when the market is rising. Now, sooner or later, the market's going to fall, and you're going to get one of those red triangles. When it does fall, you're now on high alert on your stops, because there's a much higher probability that you're going to get stopped out of a share when the general market is falling. If you do get stopped out, build a cash position. You do not replace onto the next confirmed up. That's the process, and it's got a robust history of making money in both the UK and the US markets. So any questions, anything that I can help you with, ladies and gentlemen? Mr. O'Connor, everything that I talked about tonight can be done with the basic standard VectorVest product. I'm not trying to sell any add-ons. Okay. And what we spoke about at our user group, national user group last Wednesday night, which is a much, much more complicated search, then it can be done with the standard product. Louise says, if you have limited funds, we just buy 1 or 2 stocks or spread your excess more. Louise, I think you need to try and get 5, and that may cause you at least 5. That may cause you to stress a little bit about the commissions, but I think it's worth it. Okay, just remember that 5 at least. I rarely have any more than 10 or 12 worry-free stocks. Louise, we always had to start somewhere. I think that if you do make a start with this, then you're going to get off to a very good start, and I'll certainly help you all I can. We want you to be a customer, Louise, for the next 30 years. All right. So we have to take care of you. We're not trying to sell a weekend course at the airport for 3,000 quid like many people. The process works, Louise, and those of you that are new, following the process is the real challenge. And those of you that have been at this for a while will know that sticking to even the simplest trading system can in fact be problematic. Last April, I've been at this now for nearly 40 years, and last April I found it really, really difficult to buy in when it was time to buy in. The good trade is always the hard trade. I'm not talking about hard intellectually, I'm talking about hard emotionally, always. And when you find it easy to buy in, that's when you're at the wrong, buying in at the wrong place. Okay. The process is great, and Brian says the process is fun. I think that you have to enjoy it, that's for sure. Those people that go into stock markets and hate it just because they want to make money, the first little bout of drawdown and they'll be gone, yes, for sure. So folks, vectorvest.co.uk/proven. I've taken up enough of your time. Have a great evening. Take care of yourselves. Bye-bye.